Welcome to the daily stock review of Netflix. The goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. That's 3 a day. If that sounds good, subscribe to come along for the journey. Now, who am I? I'm an individual investor on the journey, 2,500 hours in over the last 7 years, and I'm sharing the lessons along the way. This is my investing process. Today I will cover how I came across Netflix and where I searched for these ideas, and the 5-minute check we're going to do to see if Netflix is worth looking into further. These are the investors that I've learned off. They've done pretty well for themselves over just a little while, and so by following the breadcrumbs they've left behind, we should be able to follow in their footsteps. Now, if you'd like the free resources that I wish I had when I first started out, so stock valuation calculators, other checklists and frameworks, feel free to grab those for free. They're linked in the description. Now let's jump in. So Netflix, how did I come across it? So two things. I've got a Netflix account. We utilize it as a family pretty often, and we do enjoy the services and how often they get revised, new things are coming out and things like that. So it is high rating personally from our family. Now, knowing the business where it's at now, I did come across it in a screen of the 52-week lows. And so as we can see, just looking at the stock price, the business or the price people are willing to pay has decreased over the last 12 months from its high. So looking at that screen can be a great way to find some businesses, especially good businesses that might be a bit hidden by their actual value in the marketplace. So let's have a look. How I do my process, I'm looking for the annual report. So I've already cracked that open. The latest is from last year. And what I want to do is find the financial statements. So with that information, we can usually make some pretty good indications of whether this business is worth looking into in a bit more of a deep dive, and if all the negatives around the pricing of the business is matched with reality or not. So Netflix-wise, what's its PE ratio at the moment? Just gives us a bit of an indication for how much the market's willing to pay. It's sitting at 22. So for this kind of business, it's kind of priced around the stage where it's not expecting large amounts of growth or growth in the cash that the business is making. And they're saying that it's going to be pretty much steady state from here on in. Now, what do we got? We've got revenues in the business from 2023, 2024, 2025 is increased from 33 to 39 to 45 billion dollars. So we go, it's in thousands, so hundreds of thousands, millions, billions. So it's pretty good. Now that growth rate is pretty high. We've got costs within the business, cost of revenues, sales and marketing is increased, but overall the operating income has gone from 7 to 10 to 13. So that's really good. That is really strong growth. Now, net income, the bottom line of the income statement, bottom line of the business has gone from 5.4 to 8.7 to $11 billion. So this is a business that is consistently growing and by a fairly significant pace. So what are we talking in terms of our net margin? So 11 to 45. So it's a bit over, what are we talking? 10 to 20, pretty much 20% in that kind of frame for the net income across these years, which is pretty strong, especially with this growth rate. So that would indicate that this is a very consistent, very strong trend. So that gives me an indication that this business has, number one, mastered its customer. And just from like own personal experience with the company, it has been a positive experience overall from us. So looking around at these kind of ideas in everyday life is where you can come up with great investments, because you also have the insight in the product, which is very important and very valuable insight to have. All right, and costs within the business are pretty controlled. So they're keeping the reins on costs pretty tight, which is good. If the business is growing and growing revenues, we want to make sure that they're maintaining that margin within the business as they grow. Now, they've also got a good moat around the business as well. By looking at those margins up around 20% net, that's really good. And it was continuing, not growing that margin, so to speak, but it's definitely holding on to it and keeping, increasing that base. So what have we got here? We've got our income. All right, I want to see the balance sheet first. So balance sheet helps understand what assets the business has: cash equivalents, total current assets, property and equipment, content assets. So for a business like this, it's got to purchase all the rights and maintain that intellectual property of the business. So content assets net is staying fairly consistent. Hasn't grown a crazy amount, and we can see that total assets hasn't really increased at all. What about our current liabilities? Pretty low, relatively. Long-term debt is small relative to the rest of the business and the income that it's generating. So total liabilities is less than the total assets. So that's a good sign. Now, what else are we talking about? Let's have a look at the cash flow statement. So with those picture of what the income statement's doing and what the balance sheet is showing on the business, we have a better picture of seeing how rational the management team's being with its money. All right, so we've got net income comes out. We've got additions to content assets. So they are actually increasing that, but it hasn't come out on the assets on the balance sheet. So it would mean that they've got effectively they're putting that money in and getting it out. Then they've got amortization of content assets. So I guess they're trying to account for the fact that they have to continuously purchase the rights to, or I guess the rights to certain movies and series over a certain time period. They might have them for 12 months and then they've got to give them back. You know, the audience gets over some of them after a time. So they're just constantly trying to swap those assets out. The value of those assets does go down over time as the audience, I guess, fatigues from it. There's only so many times that you can watch certain movies over and over again. What else we got? That's interesting. Let's just have a look at our trend for the net cash provided by operating activities: 7.2, 7.3, and 10. So it is increasing, not at a, I guess, very smooth rate, which is usually the case. Most of the time the net cash is a little bit bumpier than the net income. But we just want to have a look around at where those big changes were and if they're going to be recurring on like an ongoing basis. So we can see that additions and amortizations pretty much cancel each other out. Changing content liabilities is pretty much around the same. We've got currency changes, which is a bit bumpy. We've got our main one here, other current assets, which is the, I guess, lumpiest bump on the road. We're going from taking away 181 million over to adding 22 and then down to 790. And so then we've also got accrued expenses and other liabilities coming out as well. So you can see that those changes in operating assets and liabilities is increased as well. So if we wanted to dig through the numbers during a deep dive, we want to check out what's going on with these. Is this general trend going to be an ongoing thing, or are these one-off for a couple of things that have happened through the year? Now, purchases of property and equipment does look like the business is investing in those. So we're seeing a lot of growth. Now, I'd want to see what the business is actually investing in. So I'd want to have a closer look at this when doing a deep dive. The business could be undervalued considering how much growth the revenues are having. Usually if revenue is growing, you've then got a bit of time and breathing space to be able to reduce costs, bring the business back into having stronger cash flows, and then being able to invest that. But if your revenues start to dry up and start to decrease, there's not a lot that can be done from there. It does take a longer time for the business to be able to turn around. Now, whether that be, being caused internally within the business, not by a external factor, say for instance, a downturn is going to affect all businesses roughly the same, or that are in this line of work. All right. So business overall does look like it's been managed effectively. What else have we got? Repayments of purchase of investments, proceeds from investments, repayment of debt. So it's paying that off. And then repurchases of common stock is a good sign. And they're not just doing a little bit, they're doing a lot. And so looking at the years, majority of their money's been plowed into that. So that is a really good sign for long-term shareholders, that this business is prioritizing them instead of either paying a short-term dividend that more short-term investors like, as well as increasing the spend on purchases of property and equipment. So you got to think about what's the moat of a business like this. Are they investing in things that are going to be value add long term for the business? So it doesn't appear to be that, considering the business is making $10 billion a year and they're spending, a small portion of that on purchases of property and equipment, they're not really aiming to grow the business in any specific area. A huge amount. So selling general and admin, like continuing to get the word out about Netflix and expanding into different areas would definitely be a really good look further in a bit of a deep dive. Because at the moment, this business with its amount of growth, it does appear to be an opportunity for a value play. Now, is this business going to grow another 100x? I'd probably say, eventually it has the potential to. It does have a strong moat around the business. I think it will still be a great business into the future, but it's not going to be a business that's going to have the huge growth rates that we're trying to look for. We want to try and be finding the Netflixes and Amazons before they've become, generating $1 billion a year. We want to be able to find them a bit earlier. Now, is this business an interesting look for a value play? Definitely. There's still some really strong growth. We need to understand why most shareholders and people that are holding the stock are trying to jump ship. So by helping to understand what other people are thinking and the psychology around it, and then having a look at the facts based on the business's fundamentals, we can have a pretty good understanding of what's going on. All right, if you like this and you like these breakdowns of just quick reviews to see if things are worth looking into, feel free to check those out on the rest of the channel. Click subscribe if you want to see the latest ones as they come out. And if you enjoy this, check out this next video because YouTube reckons you'll like it. Cheers.